interest rates, the real price of capital, have been declining for the past decade or so and are expected to remain negative for at least another decade. Why is that, and what does it even mean? Part of the explanation is that we are aging, and as we age, we want to save more, which means that there is an abundance of savings. When we have more of something, its price goes down, and that is true of capital as well. The financial crisis, and now the pandemic crisis, has made us more risk-averse. We save yet again more to meet a future that is increasingly uncertain. These are factors that are true for most countries across the developed world, but the full story of what keeps the price of capital low does differ between countries. In the US, for example, the story links closely to the emergence of the digital economy. Digital services require small investments to become big, so there is not much capital needed as these companies scale up. However, the most interesting aspect is that the providers of digital services have grown big and ubiquitous. This rise in what we call concentration power is blocking others from entering the economy. In other words, it keeps the demand for investments low. The digital economy is the future, so what defines it will also define most of our economies. Undoubtedly, as these providers operate also in the EU, their power is relevant in the European market as well. However, this is not all. Investing in Europe is simply much riskier for investors than, say, in the US, a fact that is keeping them away. We do have startups in the EU. What we do not have is risky capital that will help young economies grow and thrive. This simply puts a cap on the price of capital. And as the future of the economy is digital, Europe lacks the finance that will help it compete.